Hello, everyone, and welcome to our fourth session of Netting Zero, our virtual event series on climate change from the New York Times. My name is Whitney Richardson, and I'm the Global Events Manager for the New York Times. Thank you so much for being here with us today. For those of you who've been following this series, you know that our goal with Netting Zero is to bring solution-driven ideas to the forefront and to create the conditions for more informed conversation around climate action. And as we've seen with our own coverage and reports, this conversation could not be more timely. We kicked off the series back in July to better understand how we can apply the hard-earned lessons from COVID-19 to scaling climate action. We gathered again at the start of Climate Week in September to explore what it will take to create a new zero carbon normal for cities. In October, we gathered to discuss how to change our food systems to be more accessible and sustainable. This series will continue into next year as we approach COP26 in November 2021 and the New York Times' Climate Hub in Glasgow. It will be an open, multi-use destination used for innovators, students, community members, business leaders, policymakers, and others to discuss and debate scalable climate solutions. Today's conversation between our dynamic speakers will be moderated by Christopher Flavelle, climate reporter for the New York Times. And before we begin, just a few logistical notes. Audience members, you can submit your questions through the chat function, and we encourage you to do so. You can also follow our conversation on social media with the hashtag #NettingZero. With that, I will hand it over to my colleague, Chris, to begin. Chris, welcome.
Hi, thank you so much, Whitney, and welcome everyone. It's great to be here. We'll be talking about how the financial system can help push the world to address climate change. I just want to briefly open this by saying why I think that's so important, and not just for people who care about finance. Until a few years ago, it seemed reasonable to hope that the solution to climate change might come primarily from governments who would use their power of legislation and regulation to quickly and aggressively curb greenhouse gas emissions and help people deal with the consequences of those emissions. That scenario has started to seem a little bit less certain. I don't want to say it won't happen, but there's certainly a search now for other strategies, other ways we can get to climate action without relying as heavily on government. And one focus has increasingly become this idea that banks, investors, and other financial institutions can use their influence to push companies, and by extension the public, to reduce their reliance on fossil fuels. So we're here today to talk about whether that's happening, and if so, how fast, and whether financial actors can do more than they are, and what they might do. I'm gonna turn now to Nigel Topping, who is the UK's high-level champion for climate action, and then we will introduce our panelists. Nigel, over to you.
Hi, Chris. Great to join you, and really pleased that the New York Times is using its reach and its convening power and its editorial capacity to move the conversation forward. You've asked me to lay down the challenge, so I'm always happy to do that. Is the finance sector ready? Some are, most are not, and systemically they're not. This session should not really be called transforming the finance sector for a zero carbon future, but should be transforming the finance sector for the inevitable and rapid transition to a zero carbon future in the next 20 years. And I think, let's not kid ourselves, the finance sector is not pushing the transition at the moment. The finance sector is being pulled along by others, by cities, by businesses, and by national governments now who are being more ambitious. So I think what I'd be really looking for is much more of a sense of urgency. You know, the science is so clear, and we're going to have more scientific reports next year, which are going to raise the sense of societal concern. If you're living in Australia or California, you don't need the science to know that we're really in a very different era. Clients, the asset owners are moving. More than $5 trillion now is saying we're going to get to net zero. The asset managers haven't responded quick enough. The technology continues to go down, march down those compound annual cost reduction curves, 20% a year in batteries. Hydrogen's just about to explode with a lot of projects there. The business community are way ahead of the finance community. So I really want to see us move beyond the business as usual of the finance community telling governments and businesses what to do, but saying, what is the finance sector going to do? We need to see much more ambition, really slow adoption of net zero targets amongst the finance community, hiding behind customers. Can't do that. If you want to be a leader, you got to lead. And we've got to get beyond this framing that suggests that there's a trade-off between investing in the zero carbon future and delivering returns for beneficiaries. That's a kind of a 90s mindset. We've got to go way beyond that. And finally, we've got to see the finance sector in action. Banks, look, the Fed's just about to join the network for green financial system. That's going to mean that all banks have to stress test against a rapid decarbonization scenario. You know, if you're a bank, are you ready for that? Have you even started thinking about that? It'll take you a few years to get ahead of that. Investors, as I said, the asset owners are moving, the business are moving. This change will always happen exponentially. A lot of value has been lost already on being slow to realize that coal was going to be dead in the water, to see the value destruction in electric utilities. Now we're seeing the oil majors. The Europeans wrote off $50 billion of their balance sheets earlier in the year. Exxon's just written off $20 billion. Anyone hanging on, hoping that the years of solid dividends from the oil majors that aren't transitioning is, I think, head firmly in the sand. And the insurers, you know, we have so much more physical and resilience risk now. Has the underwriting kept up? Is the portfolio in good shape? So I'm really looking forward to hearing stories of individual leadership from the speakers, but also let's explore the need for systems transformation. It won't just be a few leaders. It's got to be a whole scale change in the systems to make sure that this inevitable transition is one that is pushed, as it really needs to be, Chris, to happen at the speed that we know it has to happen. Thank you.
Fantastic. Thank you, Nigel. So let me now introduce the speakers on our first panel. Sagarika Chatterjee is Director of Climate Change at Principles for Responsible Investment. Jennifer Wu, Head of Global Sustainable Investing for JP Morgan Asset Management. And Adi Mukherjee is Head of Climate Risk Management for Standard Chartered Bank. Sagarika, maybe we can start with you. Two questions. First, could you just walk us through briefly what PRI does? And I think more importantly, describe the landscape as you see it right now. What do you see financial actors, asset managers and investors and lenders doing differently as climate change gets worse? What are the areas where you see movements, and where do you think there needs to be more movement?
Great, thank you. So PRI is a global investor network. We've got 3,000 signatories. Who are they? They are pension funds, they're endowments, they're sovereign funds, they're government funds, they're insurance, asset owners, investment managers, investment consultants, credit rating agencies. So let's turn now a bit to kind of what PRI does. So our role is really to push, encourage, help the global investment industry in really understanding climate risk and then stepping up to capture the opportunities. And the way we can do that is through softer things, providing guidance, convenings, but we've also got some muscles we can flex, and that includes the requirements for being a PRI signatory. So this year, what we introduced is the requirement that all PRI signatories report on climate risk. And I'm pleased to say they did. But that's not the whole story. Where's the landscape in finance? Well, Nigel's absolutely right. We just aren't seeing enough leadership right now on climate risk or on net zero in the finance community. There are pockets of leadership, and I'll highlight one development that I think's very good, which is this week, State Street Global Advisors joined a global climate investor initiative called Climate Action 100 Plus. And that, I think, is a signal of how this topic is becoming more mainstream. And just to recap why Climate Action 100 Plus matters, Chris, you mentioned at the start how we're starting to see investors pressing companies. So this is 500 investors with 40 trillion in assets under management, asking the top 160 emitters to reduce emissions. Now, where I think the finance community has significantly developed is in climate risk, understanding it, smarter tools, strong analysis coming through from regular financial analysis, and credit rating agencies have really stepped up. And I'm also seeing leadership amongst asset owners starting to emerge. So recently, 33 asset owners, including some from North America, CDPQ, CalSTRS, David Rockefeller Fund, sorry, CalPERS, not CalSTRS, and David Rockefeller Fund joined the Net Zero Asset Owner Alliance, making a public commitment to align their portfolios with net zero and set interim targets starting 2025. But where are the banks? Where are more of the insurers? Where are the investment consultants? We're seeing the central banks and supervisors step up, but we need the whole of the investment chain. We need savers, we need consumers, all of them need to be a part of a transition to net zero.
Addy, let's move to you. Speaking of what lenders do, so Standard Chartered is one of a growing number of banks that has said it will no longer finance new oil and gas projects in the Arctic, in the Alberta oil sands, and I believe in the Amazon. A growing momentum in that direction, but for the most part, almost no lenders have said we will stop financing oil and gas entirely. Maybe walk me through how it looks from inside a bank. Why go part way? Why not just say there's a risk here, reputational, transition risk, a risk we'll lose money, and just not anymore fund oil and gas projects, full stop?
It's a great question, Chris. Thank you. Absolutely the right questions to ask. The answer is that it's not that straightforward, and there's quite a few factors leading to banks not yet pulling any financing directly from the oil and gas sector. Let me just walk you through a couple of those. So first of all, there is a need for reliable access to energy. And that does not have to come through oil and gas, but in some of the emerging markets, fossil fuel sources are still viable, commercially, potentially the only option, and that's necessary for the next 5 to 10 years. So it's not a straightforward, let's switch this off and switch on something else. It's not that straightforward to do that. It can be done at the cost of access to energy, and if you look at the emerging markets where Standard Chartered's core footprint is, it is most of our kind of markets within the least developed parts of the world still need access to reliable energy. A bit of a personal anecdote here. I grew up in India back in the 80s. And when I was there, most of the summer afternoons, we would not have access to power. I know it sounds weird for most of us listening to this conference, but it is a reality. Now, I turned out all right, and some of my mates did, but not everyone does. So it is a big challenge. The second point that I would like to raise, keeping the standard arguments around job losses and all that aside, where will the transition come from, right? So if you think about it, is a massive challenge to solve. But if you think about energy transitions, energy companies have to be at the heart of it. Now, who would be these players? Who is going to transition? Who is going to give access to power while transitioning? It is most of these majors. Now, some of them will not transition, which is something that we would have to pick up either through client level engagement. So we directly engage with the corporate, understand their plans to transition. And if we feel that their transition plans are not credible enough, we pick that up through either our credit process, or we pick that up through the stress testing that Nigel referred to and take actions on that. So all of those risk assessments eventually lead to cost of capital. And when it starts hitting the cost of capital, it starts hitting the companies directly driving their actions. And the third thing in all of this is the word transition. So as it has to be fast, it has to be urgent, it has to be quick, but it has to be a transition. It's not a switching on and off thing. So to do that transition, I think two critical things need to happen from the bank's point of view. One is the level of awareness that needs to be raised, not just internally within the banks, but also externally with our clients. And again, if you think about the emerging markets landscape, with a lot of our clients, these issues are new. They're not quite as aware as the European major oil and gas major would be. So it's kind of incumbent on us to walk them through, educate them somewhat to come up to speed on why they should transition, why they should have protection, adaptation against physical risks as well, I would say. The second thing is technologies. Now, there is obviously two roles that the banks can play there. One is invest into new technologies, help them scale up, and two, increasingly point out the risks with some of the existing technologies and basically point it out through the training and awareness scheme to our clients that if we stay invested in some of these 90s technologies, almost kind of borrowing from Nigel, it's going to cause you to lose money. It's going to cause us to lose money. We don't want that. It's ultimately a returns game at the end of the day. So we can quantify the risk, get people aware, we start to transition. And that's what at least Standard Chartered has been doing, as you referred to, with some of the restrictions, some of our positions on thermal coal as well. We've said we'll not bank anybody who's got more than 10% revenue reliance on thermal coal by 2030, amongst many other announcements and commitments that we've made, including being aligned to the Paris Agreement for our core lending portfolio.
Jennifer, let's bring you in. The question that comes up for me with investors and your clients as an asset manager is the degree to which there's tension here, right? I mean, there's a sort of there's a school of thought that says it's actually not hard to move investment dollars away from fossil fuel intensive industries because there's so many great investment opportunities. You don't have to sacrifice returns. I've never been fully convinced like that. I feel like that seems a bit too rosy. Give me a sense from your perspective, how much there's a tension here between performing well just on the numbers and also trying to begin hitting some of these other marks around climate action. To what degree are those two goals not always aligned?
That's a great question. Thank you, Chris. I think we're at a point whereby this is no longer a debate. I agree with Nigel. I think we passed that point whereby the trade-off is not so much if you're leaning towards a low carbon portfolio or you're leaning towards a net carbon target as part of your investment policy, you're going to have to suffer some kind of a return trade-off. I think the world that we're living in now with regulations coming online, which will incentivize one way or another businesses to really decarbonize their business mix. And then also new technologies that effectively render a lot of these new technologies that are cleaner and greener a lot cheaper. I think with all of these forces coming into play, as a matter of fact, if you don't move your portfolio to be more aligned to a low carbon economy or Paris targets, that's the trade-off that you're looking at. Because I think the way that we think about it, especially in the last 18 months with all the changes around, activism in the public space, right, with people coming to the streets and then really customers demanding companies to change, is that, well, these are real tangible risks that we're looking at. And it's really going to manifest themselves in the next 2 to 3 years. So how do we actually think about making the changes that we need to do to mitigate these potential risks that we probably didn't really have to think about 5-10 years ago, if you like. But so to me, I think the trade-off here is that if you don't do anything, you're actually going to suffer potential losses that you never thought about. So I think that's one aspect to it. But I agree with the point raised earlier. It's there's still quite a bit of education that needs to be made. And I must admit, I think asset management as an industry has been slow moving. But I think this year, because of COVID, I think there's a much greater appreciation of how being prepared for systemic issues like health crisis, climate crisis is just so important, right? And I do feel like the asset management community is finally coming together such that we're really doing hopefully a much better job in providing the information to our clients. Not all of them are ready. Right? Not all of them understand that this is the kind of trade-off that we're talking about, which is very different from what we were saying 5 years ago, and that here are some of the solutions that you have to make. So I think the dialogue has moved, we joined at JP Morgan Asset Management, we joined Climate Action 100 Plus at the beginning of the year. And we also have been really active in participating in a lot of the initiatives around like defining a net zero investment framework for investors, institutional investors, and how do we go about rethinking strategic asset allocation, right? If you really want to reach, for example, net zero, actually, it's not going to be enough if you look at individual parts of your portfolio. You probably have to really lean into the alternative sides of your portfolio to tap into new technologies and opportunities that are predominantly owned, many of them, by startup and private companies. So I think take one step back. I think the trade-off is if you don't do anything, you're actually going to be suffering potential losses. So you need to be prepared. And then on the flip side, there are real investment opportunities that you should get really excited about, because that is something that if you wait until all of these risks and opportunities are priced in by the market, you're really missing out. And beyond, and besides that, you haven't really contributed to this transition, right? Which is what I think at the crux of the issue. Like, what is the responsibility of asset owners and asset managers and every participant in the finance industry? I think we all play a part.
Chris, I just wanted to make one really quick point, very short, which is on this key point of performance and this perception that, are you sacrificing performance? So one indicator I wanted to highlight that was in the first quarter of 2020, in the midst of the pandemic hitting, what was an interesting thing that was released by BlackRock was that they had better risk-adjusted performs across their sustainability products. And they published a piece trying to understand and explain why this was the case.
It's a great point. Just to be devil's advocate, if it were the case that there isn't any trade-off, and if you're a lender or an asset manager, you can perform just as well by financing only zero carbon industries, then my question would be, why is any money still flowing towards oil and gas or other carbon intensive? It seems like I'm skeptical that the picture is as rosy as we're discussing at this point. There must be some friction somewhere.
So I'll quickly answer, and I'll turn over to our finance institution colleagues. So in my view, I don't think the financial markets today are really pricing in climate risk. And there's multiple reasons you can see for that, including time horizons. And so we've commissioned some analysis called the Inevitable Policy Response. That takes a view on 2025, and it goes further out as well, 2030. What we've found through that analysis is that there is likely to be a government response to climate change, but it's going to be delayed. 2025 isn't that far off, but it isn't today. But when it comes, therefore, it will be forceful and disruptive. Now, that creates stranded assets, but it also creates unprecedented opportunities in areas like nature-based solutions, forest finance, a whole realm of new opportunities that will open up.
Adi, do you want to take that? What do you find that the greatest conflict is as you try to help the bank manage its climate risk, which I assume, because you're doing that job, sometimes runs against the grain of what would otherwise happen at the bank? Yep. What are the hardest conversations to have in terms of helping people, your colleagues or your counterparts, get their head around this kind of change? Where's the greatest resistance that you find?
Resistance, I mean, look, there is a natural resistance. I think, Chris, I would agree with you. The picture is not quite as rosy as we may think it is. There are a couple of things, I guess. So one is historic data does not, I know there is kind of analysis of the recent COVID hit, which impacted oil and gas companies quite badly, including sort of potentially a transition impact, but a lot of COVID impact, which obviously makes the sustainability linked funds look a lot better in terms of their performance. That is a one-off. Now, if you look at, it may be a systemic one, it may be a one-off one, I don't know. But if you look at the modeling techniques, the historic Basel Accord, the advanced IRB internal rating-based models that banks have been doing, risk modeling, stress testing, it's all based on at least 5 years of data. And if you look at last 5 years of, and for a reason, right? You want these estimates to be stable. You want these estimates to be robust. Now, if you look at the last 5 years of data, and you look at, let's say, renewable energy as what we like to think as a zero carbon sector, it's not quite zero carbon, by the way, but if it were to be a zero carbon sector, renewable tariffs have been falling, which is great for the society, which makes it accessible for all. It's not great for banks, because if you're lending money to a client who's producing power, let's say at $100 a unit, and selling it at $50 a unit because the price changed between the time it produces and between the times it sells it, it's not profitable. And there have been some of those issues, but I think we're beginning to turn a corner on that. I think prices are stabilizing and the markets are realizing more and more that, look, it is not priced in, as Sagarika said. It is increasingly in our conscience. It is increasingly in our client conversations. It is increasingly in 2 dimensions or 3 dimensions, I'd say. So first of all, it's in the risk assessments, and there is no walking away from that. The regulators have mandated in the UK, and Standard Chartered being a UK regulated bank globally, we are subject to the PRA regulations, which mandates us to do climate risk assessments, both physical risk and transition risk. And as part of that, we have to do stress tests as well. We are undertaking the most ambitious stress test, I'd say, on the climate front or otherwise next year, which is the biennial exploratory scenario, which also forces us to go and interact with our clients, understand their plans, and so on and so forth. The second thing is we are measuring our impact, and this is very, very important. You would not have seen these reports come out 2 years back. So if you just look at Standard Chartered, and I would like to say it's not just Standard Chartered, it's other banks as well. We have just issued our sustainable finance impact report, which is looking at how much we have financed, what's the net savings of emissions from that. And that's, so in there, it's quite important to see how much and where as well. So if you look at a solar power plant in India, that saves 7 times more emissions than a similar size solar power plant in France, given the current grid that operate in these markets. So it's quite important as well. And the third thing is the opportunities. So we've also issued a report called Opportunity 2030, which is calling out a $10 trillion investment opportunity within the emerging markets, within 15 of the world's most dynamic and growth-oriented markets, where to meet the SDGs, the goals of the SDGs, the Sustainable Development Goals, that funding is needed from the private sector. And we are mobilizing and we are acting on that. We've got teams within the business with revenue targets, looking at expanding. Our initial target for sustainable finance at some point between 2016 to 2020 was $4 billion. We blew through that within 2 years, and we have upped that $4 billion to now $75 billion of funding and facilitating. You know, it's not enough, you might argue, and I would take that argument, but it's, again, it's the direction of travel and how fast we're traveling.
Jennifer, let me ask you the last question for this segment. And it's going to sound perhaps a bit coarse. How should we judge? How should journalists or environmentalists or governments judge asset managers or other financial actors in terms of their progress here? I mean, Adi mentioned the numbers game, right? I don't mean game that way. Presenting how much has been invested in green technology, renewables. Another would be disclosure. There's many ways to try to gauge how much an institution is doing on climate change. What do you suggest is a reasonable and fair metric for somebody on the outside to get a sense of how well any bank or asset manager is doing on moving forward on these goals? What should we watch for?
That's a great question. So I think part of the reason why, listening to the other 2 panelists, and I agree that it's not being fully priced in, which is why it's very exciting, because we're at the beginning of a big transformation. But part of the reason why it's not priced in is that I think one of the measure of success is focusing on how much green products do you have, right? If you're an asset manager, right? How much assets that you're allocating into these type of new technologies and investment opportunities. But I think what really needs to change, and we basically went through this in the last 2 years, to effectively make sure that climate consideration is in every part of the investment decision-making processes across the entire investment platform. So it's not just a suite of green products that we're running, but it's actually, it has to be embedded into everything we consider, right? So it goes to, how is climate risk impacting cash flow of a company, even though the company is not actually in the energy sector. I agree with Adi, like energy transition is really at the center of our transition to a low carbon economy. But beyond that, there's so many other sectors that we need to be just much better educated about, in terms of what they need to do in order for us to reach the net zero target. And to do that, you can't really have all of these silo green funds. What you need to do is climate risk is front and center in every part of the investment decision-making process, and that it needs to be embedded in what we call like ESG integration, right? If I think about one of the biggest risks and opportunities when it comes to any kind of ESG factors, I know we talk about a lot, and this year there is much greater focus on the S of the ESG, right? As many of us have been focusing on. But at the end of the day, climate risk is just not priced in. It's the biggest source of risk and opportunity as well. So it requires lots of internal education and change in behavior, right? How do you really tag that to make sure that ESG metrics is built into investment professionals' individual performance assessment, right? I think linking that to incentives, linking that to how you're paid is actually very important, not only because it's the right thing to do, but it's really just very important. Thinking about being a fiduciary and how you can really truly making sure that you're looking at all the tangible risks and opportunities on behalf of your clients. I think it's a duty that we need to do, and you need a little bit of a push to change behavior. And I think that could be one way of looking at, okay, is climate part of your investment considerations across the board? So that's one metric. And then the other thing is, do you actually have these metrics, these ESG metrics or climate target metrics built into the investment professionals' performance assessment every year for an asset manager, for example? I think these two could really move the dial and really accelerate a lot of the changes that need to be made.
Yeah.
And Chris, if I may quickly, I think there's two things for a journalist to watch out for. One is net zero targets, getting under the skin of those, whether they're from a finance actor, an insurer, a bank, or an investor, or from a corporate. And then the second thing is, in terms of impact, green jobs. So we have to make our recovery from COVID sustainable. And there has to be a focus on green jobs and the new economy that needs to be a lot more inclusive of all workers and communities.
Sure. We got to switch now to our second panel, and we're going to bring back our first three speakers after that. So our second panel, who I'll introduce, we got three great people here. Number one, Marilyn Waite, who leads the Climate and Clean Energy Finance portfolio at the Hewlett Foundation. Mindy Luber, CEO and president of Ceres, which is a group that works with investors to address climate change. And then finally, Eli Castrogut-Staub, executive director of Majority Action, which is a nonprofit that helps shareholders push corporations to become more socially responsible. Thank you to the three of you for joining us. Marilyn, maybe I can start with you, and I'd like to ask the same question that I asked Jennifer at the end of the last session, which is, how should we judge the progress that any particular bank or asset manager or other financial institution is making on climate change, separate from the organizations they've joined, the numbers that they can throw up saying that they've invested in renewables? What strikes you as the right, fair, and useful metric at judging progress on this?
Chris, can you hear me well?
I can. Yeah, you're all set.
Thanks for this, and I appreciate the former panel. I actually think it was well said in the last panel, in that there's a realization now that climate change is the entire economy. We have to comprehensively decarbonize, not just energy, but also transportation, agriculture, land use, across all sectors and across all asset classes. So in short, it's the carbon, stupid. That's really where it is. We have to measure and manage the carbon emissions across all the financial asset classes. The good news is that it's happening. So now we have over 80 financial institutions, so both banks and asset managers from Asia, Africa, the Americas to Europe. They're measuring, disclosing, and reducing the carbon emissions of their loans and investments. And this represents over 18 trillion of assets under management. So it's happening. It needs to happen now for all the institutions. So that's where the regulation comes in. And that's where more and more banks, asset managers, credit unions joining the effort makes a big difference.
Eli, we've spoken before about this question of just how much asset managers can do beyond just selling positions in a company to push change? And you made the point, I want to invite you to make that point again here, that there's a lot they can do, and it's not always clear, I'm paraphrasing your words here, that they're doing it. Maybe give us some idea of, to your perspective, what these financial actors can do to push on climate change and to what degree they're doing it.
Thanks so much, Chris. And I have to say, I really appreciate this question and the question about how should we be judging? Because that question is absolutely fundamental, because it would be very easy for audience members, for example, to walk away hearing a lot of conversation about stress test and addressable market and risk-adjusted returns incorporating climate risk, and think that we were seeing the level of activity commensurate with the kind of risk that we're actually facing. And we're not. And that's really important to start from a recognition of that fundamental fact. And that's because climate change is not just another risk, as Marilyn is saying. It is the systemic risk to end all systemic risks. It is escalating, it is irreversible, it is systemic, and it would drive a level of disruption that is not reflected in the way that the finance sector overall is addressing this. With respect to the asset managers, let's start there for a moment. Asset managers have tremendous power to ensure that the companies that they hold are actually achieving the kind of decarbonization transitions that we need to see. Just 3 companies, just 3 asset management firms, BlackRock, Vanguard, and State Street today control 25% of the voting power across the S&P 500, giving them unmatched and unprecedented influence over company behavior. They have the power to go to corporate boards of directors and say, look, either you lead your company to our net zero future now, or you will be replaced with leaders who will. But as our research at Majority Action has demonstrated, the largest asset managers, those that we've entrusted with our retirement savings, have instead been shielding corporate boards from accountability. The largest of them, for example, BlackRock, voted for 99% of company-backed directors across oil and gas and other critical sectors for the energy transformation in the United States in 2020. And despite joining and receiving praise for joining the Climate Action 100 coalition, the Climate Action 100 flagged 12 critical climate resolutions in 2020, and BlackRock voted against 10 of them. And so when you ask, how should we judge? What we need to understand is to what standards of transformation, not just disclosure, are asset managers holding companies accountable? And are they backing that up with their shareholder voting power? You assess that and you have a really good measure of how seriously an asset manager is taking it. One last point, Chris. Just yesterday, Federated Hermes, a $1 trillion asset manager, just announced that they will be voting against board directors at companies whose strategies are materially misaligned with the goals of the Paris Agreement. This is not something that cannot be done. It's already happening. We just need the largest and most powerful asset managers to get on board.
Mindy, let me bring you in here. You're very plugged into this world. You talk to these people. Give me a sense of, to your mind, what you think is holding this up. Why is it, to follow on Eli's point, why is it that asset managers are not more aggressively using their influence, do you think, to push these outcomes? Is it, I think you might still be on mute.
Great question. Chris, and I'm going to answer that question to be sure. The subject of this discussion is transforming the financial sector. And we've got to look at that systemically. I'll answer your question about asset managers, though I think it's perhaps more relevant to asset owners, despite what Eli said. But right now, until we have the right market signals, starting with a price on carbon, people talked about pricing in carbon. What does that mean? It means right now, carbon pollution, of which it costs society billions and billions of dollars a year, is priced in most places at zero. When something's free, we get more of it. Until we put a price on carbon, so you put more carbon pollution into the air, you pay for it. Now that's not going to stop everybody, but capital market systems, of which financial players are part of, work well with honest pricing signals. And when you have dishonest pricing signals, they don't work so well. So we can't transform the financial system without looking at those kinds of policy issues. Then if you look at the federal financial regulatory system, right now in the United States, they don't really look at carbon, despite its material financial risk or its systemic risk. Now, I'm optimistic because unlike last year when the Federal Reserve in our dozens of discussions talked about the fact that they did not see climate as a systemic risk that they should regulate, now they do. Chairman Powell said 2 weeks ago, climate is a financial risk. We must look at it. We must figure out how to regulate it, as the Bank of England, the Bank of France, and others did. And that regulation will come in the form of regulating banks, making sure that banks disclose their full risk, not just their risk from investing in oil and gas, but their risk from investing in insurance companies that are paying out billions of dollars, literally every sector of our economy. So banks need to be disclosing that full set of risk, not just a narrow set of risk. The Securities and Exchange Commission, I mean, there are lots of people saying voluntary disclosure is great. We need more companies to disclose their risk. In the end, you need a level playing field. Whatever policy we expect of one company ought to be expected of everybody else. So we need a level playing field where the rules of the game are consistent. Mandatory disclosure of climate risk because it's a material risk, not unlike trade risk or inflation risk or currency risk. I mean, we've got to take climate risk out of the cute bucket of environmental risk and into the fundamentals of financial reform. And so as you said, and as Nigel said at the outset, we could do a lot to transform the financial system by working with 10 asset owners or 20 asset managers or working with 400 companies. But until we have the right regulatory mandates, and not all regulation is bad. I am a former regulator, but a lot of regulation is good. We've got the auto companies now supporting regulation of emissions from auto companies because they want a level playing field. Ford wants everyone to do what they're committing to do. So to get on with the business of getting the kind of substantial change, not 10 companies by 10 companies, 20 asset owners by 20 asset owners, we've got to look at the policy frameworks. We've got to look at the regulatory frameworks. And I will tell you, Chris, a year ago, that was a distressing thing to look at. Now I couldn't be more optimistic. I don't think it will be easy. There will be opposition every step of the way. But when I see the people that are being put in the United States to the Treasury Department, which has a huge role, and into the regulatory agencies, I feel like there's promise. One final thing is, given the amounts of money moving through our system, right now we're looking at perhaps a couple of $1 trillion with a T to deal with infrastructure, building out better, coming out of the COVID economic slump. We've got to make sure, and I think the Treasury Department, others need to make sure that that money is spent on not a fossil fuel economy, but a new economy that's clean, that's greener, that's well beyond energy and transportation, and that's equitable. When we're looking at how to spend that money, it's not only on roads to the suburbs, it's on mass transit. How do we build out a cleaner and more equitable economy? And I think we could do it.
Marilyn, let me bring you back in. It seems like we've landed on a useful distinction here, which is whether the action we're talking about, the change we're talking about from the world of finance ought to be driven by government and regulatory change, in which case banks and asset managers can respond to those changes, or whether it's appropriate to hope and expect that those financial actors can lead it, can sort of step out ahead of what they're required to do. You know this world well. How realistic is it, do you think, to hope or expect that lenders and asset managers and institutional investors actually go further because of public pressure than what regulators are telling them to do? Or is that just wishful thinking?
Well, you need both. Right now, the reality is there's very little regulation happening. There's a lot of action happening. So you do have leadership banks and leadership asset managers from the small to the large. To get the whole system moving, however, you need the regulation. So you have to have both. You have to have examples, and we have them. We have B Corp certified banks. We have banks that are members of the Global Alliance for Banking on Values. We have banks that have signed up for PCAF, and which is the Partnership for Carbon Accounting Financials, and asset managers. So we have examples of leadership and doing things that are voluntary, but we have to have also regulation so the entire system can shift towards that. I want to also comment on something that Eli mentioned, which is around the asset managers. I think another thing that we can really look at to see if they're really leading this transition is their defaults for their benchmarks. So a lot of asset management is really in public equities, so those listed stocks. And if we want those to shift, if we want our capital to move towards the low carbon energy economy and the low carbon agriculture economy across all those sectors, then we really have to have the benchmark be a low carbon one. Right now, MSCI World Index, that's the standard. It's not the low carbon version of those benchmarks. So that's also something we need to see. We need to have our entire capital markets be benchmarked against the future we need to have now. So that's something that I think is also often overlooked in addition to the proxy voting.
Let's stick with this question of systemic change. And Eli or Mindy, I'll make this open to both of you. To what degree, based on your conversations with people in the world of finance and also what you see regulators doing now, to what degree do you think a Biden administration will meaningfully change this landscape? To what degree do you think there'll be real pressure on financial actors to move more aggressively on this? Eli, do you want to start?
I would like to here's what I want to say on that, because I think it's a really critical question. I think that there will be really critical interventions that the Biden administration can make. There is real concern from many about the prospect of further policy capture by many of the institutions that we're talking about here, that, like in the aftermath of the financial crisis, led to a diminution of the level of government action that was unscaled with what was actually needed. So I think that it's one of these concerns, and that I think that if the Biden administration is serious, they'll give very close consideration to these questions of personnel and the degree to which staffers from BlackRock or other leading financiers of the fossil fuel economy, like JP Morgan, are actually going to be embedded in leadership roles inside the administration.
Mm-hmm. Mindy, do you want to take that? Then I want to take a question from some of our viewers.
Yeah, Chris. So we've had 5 conversations with the transition team about reforming the federal financial system. I think without question, this is high on the agenda. We've seen it in the Biden climate plan. We're seeing it with every discussion with the transition team. Just think about the Secretary of the Treasury has written a book on climate risk and has been an active supporter on price on carbon and has not been shy about it. Maybe she worked for some financial firm. I don't quite know what the issue is, but she has been an active, outspoken advocate for pricing carbon for decades. The people being considered on the Economic Council are people who have staked their careers, their claim, their lives on moving climate policy. So I don't think it will be easy. Let's be clear, moving the Federal Reserve to even catching up with the Bank of England or the Bank of France will take some time. But the difference between yet a year ago and now, even the last month, is radically different in the language coming out of the Federal Reserve governors. The difference at the Securities and Exchange Commission in talking now with us about mandatory climate risk disclosure, not voluntary, radical change. And so I do believe we'll have fights. There'll be people who oppose each and every one of these things, but we now have an administration that's looking to prioritize through the regulatory system, both the EPA for methane, for climate risk, for auto emissions, but the federal financial regulatory system. We've talked with almost every regulatory agency, the Commodities Futures Trading Commission, the SEC, the FSOC, the Financial Services Oversight Committee. Every one of them are looking at climate risk now. A year ago, it was nowhere on their agenda. So I don't want to be Pollyanna-ish. I've been fighting these fights for decades and decades, both through voluntary measures and mandatory. But if there were ever a time where we have a shot at some change, literally the kind of transformative financial sector change that your session is about, I think now's that time. We just have to have at it.
Let me turn now to some questions coming in from the audience, and a few questions have been along these lines. I've got viewers saying some version of what can they do as individuals, as investors, as people who I assume have 401ks. What can they do at the individual level to try to help on this front? Marilyn, do you want to start on that?
Sure. So there's two sides. There's the banking side and then the asset management side, especially with individuals. It's your insurance company and your retirement savings. On the banking side, where you're doing your everyday banking, that matters. For every $1 in that account, the bank is leveraging that by 10 to 15 to do one of two things: help the planet or harm the planet. So you want to align that with those that are helping the planet. There are a number of banks that are doing so. There's a website called bankforgood.org in the United States. It's focused on the US for our international listeners, but there are equivalents around the world where you can find those banks that are climate forward and that are integrating ESG. On the asset management side, so for your retirement savings, whether it's a pension, well, if it's a pension, it's a different story, actually. It's a bit harder. If it is a direct, defined contribution, there's a lot of choices in there around ESG and around climate forward products. And so just ask your benefits manager to have those be your defaults, and make sure that they are climate friendly, that they're using an index, a benchmark that is low carbon, that is not high carbon, that's not the top 100 stocks, but that it really is focused on the low carbon economy, and talk to your asset manager and your insurance provider to make sure that they are not investing in a carbon destructive world and that they're aligned with Paris. Mm-hmm. Those are some of the things that you can do.
Eli, last question in this segment is for you. Give me a sense of what you're looking at in the next, say, 6 months or a year in terms of companies, investors, government. What should our viewers keep their eyes on to see just how much progress is happening in this area?
It's a great question, Chris. I think a really critical thing to keep an eye on, let's start with the banking side. A really critical question to keep an eye on is, to what degree are large financial institutions, including ones represented in this discussion, despite climate commitments, continuing to finance the expansion of fossil fuel production and use at their historically large levels. We already have enough oil and gas, for example, under various stages of production, that if we consumed all of it, we would blow past our global carbon budget to stay within 1.5 degrees. But JP Morgan, for example, provided at least $268 billion in financing to the fossil fuel sector since the Paris Agreement alone, making them the largest financier of fossil fuel expansion worldwide. So for example, they've been a big backer of the company behind the Keystone XL pipeline. Is JP Morgan's climate commitments going to lead them to continue to allocate money to really climate destructive projects like that? Or are they going to actually turn these kinds of new risk assessments and risk profiles into real action? That's one thing. The second thing, I think, is really along the lines of the asset management industry. This shareholder season in 2021 is going to be absolutely pivotal. There are once again going to be critical votes on boards of director elections and shareholder proposals calling on companies to actually transform their businesses in line with the mandates of the Paris Agreement. Are we going to see the largest asset managers, particularly BlackRock and Vanguard, who have been the most recalcitrant consistently across the board in their voting power? Are they actually going to step up, or are they going to continue to shield companies from accountability? And then the third, and I strongly support all of the initiatives that Mindy was just talking about. I very much hope that the government action will be able to address the kinds of issues on scale and create the kind of level playing field that we're talking about. But I think a really critical question going forward is, are we going to continue to see leadership, real leadership, from this finance sector that is not a bystander, in climate destruction, but in fact has actually been a co-conspirator within it? That's really a critical question, and one I hope to see a real about face on in 2021 and beyond.
This might be the time to note that we asked BlackRock if they wanted to participate, and they weren't able to. So I'm going to now bring in our earlier speakers, and we're going to have a smorgasbord of faces on your screens. Can we get everyone back in, and perhaps some of the members of our first panel want to respond to some of the points that we've heard? Jennifer, JP Morgan got mentioned a few times. Do you want to respond to the points about the degree to which JP Morgan is using its clout to try to push change at these companies?
Yeah, absolutely. So I think JP Morgan Chase as a group has made various commitments really loud and clear from the beginning of, well, from last year and then this year as well, around how this is really front and center for the entire group. And for me, representing the asset management side, as I run sustainable investing on the asset management side of JP Morgan Chase, I think for us, this is really, really a focus. Like I said, we've done the work in the last 2 years to make sure that climate risk is front and center for every one of our investment professional, right? So it's not just a few portfolios that we run for some of those green investors, if you like, but it's front and center. And also when it comes to engagement and voting, it has been a primary focus for us to really make sure that this is an issue that we talk to every company about, and that in our engagement with those companies, we set clear targets and expectations based on our understanding of where they are at, the challenges that they have, and the technologies and opportunities that they're exposed to, what's realistic, and we expect them to, keep the dialogue going with us and demonstrate that progress, right? Because I think it's going to be more and more. You will see more in 2021 and years in the few years to come on how we're just going to really ramp up our focus on this particular issue, because we think it's important both for I think our clients from a return trade-off perspective, but also I think more importantly, like I said earlier, we all have a role to play in the financial industry, in the finance sector, right? And the role that we can play as asset manager is to make sure that we provide all the information as clearly as possible to educate external and internal stakeholders and make sure that they understand this, so that we could really effectively incorporate those into how we make investment decisions.
Adi, I want to give you a chance to do you want to respond to this point that there's already enough oil and gas in production that if we burned it all, we'd blow through our carbon budget, which at least seems to raise the question whether it makes sense to finance new projects. What's your take on that?
So I think there's a distinction between financing a new oil and gas project and financing a company which is primarily a player in the oil and gas sector. And a lot of our measurements in this space, I'm afraid, is not quite picking up the distinction between the two. So when we say that we've got this amount of exposure to the oil and gas sector, there are some companies that are tagged to a certain sector code which says oil and gas. But if our exposure to them is essentially helping them set up, let's say, a renewable power plant, that exposure in some of the classifications is getting categorized as, as an oil and gas exposure, which may not necessarily be the case. And I think I'd just pick up on two points on that. So I think you're absolutely right. The trajectory now does not look good. And we are beyond the point of debating that. And if we were, then we wouldn't be having this conversation. So I guess two things from the financial institutions point of view. One is absolute innovation in products. And I think, as Jennifer said, it's all of our bank. It's all of the business, not parts of the business. So I tried to coin a word, mainstreamization, a few years back, didn't quite catch on because it's not a proper English word. Mainstreaming is the right English word. So I think including this into the mainstream of financial decision making, not just the risk, but the opportunity as well, and the innovation. So for example, it's not just sustainability linked bonds or green bonds or blue bonds. There is a task force for scaling the voluntary carbon markets, which is also linked to one of the audience questions around the climate dividend and fees, which is trying to figure out what is the right price on carbon that we should put in, and the market can trade and decide on that. And the second element on that is absolute demonstration of progress. There was a question from one of the audience members around. So there are some hard to abate sectors like steel, cement, and to again Jennifer's point, the interconnectedness of this system is huge. The conversation that we are having now is supported by emissions. Without putting these emissions into the air, we would not be having these conversations. It goes far deeper than most of us realize. So one, that training and awareness, and two, transition, that's the key word. And in that process, if the companies which are willing to transition, according to us, at the right pace, we absolutely need to support that. In my view, divestment is an option, is not the only option. And where companies say that, look, we understand what you're talking about transition, we just don't want to do any transition, basically get away from our face, we do walk away. That's the only option that the banks have got. And that is happening. That's going to increase in pace over the next couple of years. Should we do more of that? Absolutely. Is it happening? Yes. So I'll just kind of lay out that landscape to make people feel sort of slightly kind of stand up for the financial sector somewhat and say that it's unfair to say nothing's happening. It's not happening at the scale that we need, and that's not just the financial sector. Globally, it's not quite happening the way at the scale that we need. We are flagging all the red lights, all of us on this panel and beyond, to make sure that the pace increases. But to accuse financial sector of not doing anything at all would be slightly unfair.
Marilyn, we got not a lot of time, but I'm going to try and make sure everyone gets a chance for sort of a final word. Give me your sense, Marilyn, of how somebody who is watching this session should walk away from it thinking, are they doing enough or aren't they? I think people can probably pick and choose the narrative that they prefer the most. What's your sort of closing thought, if you would, on this question Adi has laid out, whether or not banks and asset managers are in fact doing roughly what they can at this point?
On a whole, not enough. No. On a whole, we're still on a 3.5 degree Celsius trajectory. So of course we're not doing enough, that the sector is not moving fast enough, is not accelerating enough, and is not decarbonizing across all their asset classes quickly. But it is poised to do that now. So there's no question about the amount of resources and tools that are now available to act quickly. So there's no excuse anymore to not move on this. And so there's both of that. And there's a role for everyone to play, for consumers, people, for small businesses, for large non-financial corporates, and for the financial institutions and government. So all hands on deck now. Let's get it done.
Mindy, let me go to you. You mentioned a huge array of financial regulators in the US where you're seeing action. For mere mortals like us who can only watch a handful, are there 2 or 3 things that you think the Biden administration really has to do to increase the rate of change when it comes to the world of finance, at least in the US? What should we pay attention to in terms of developments there?
One is fight for a price on carbon. That may be tough in the US Congress if it's completely divided, but this is a capital market systems change, not an environmental change, and hope we would have a shot at that. 2 is, if there is an infrastructure bill, $1 trillion, $2 trillion, I want to see Janet Yellen out there personally, the new to be declared Secretary of the Treasury, making sure that money is directed towards a non-fossil fuel economy with equity embedded in every decision made. The 3rd is I want the SEC to mandate the disclosure of climate risk and to enforce against it. Remember, companies are supposed to tell the SEC if they have a risk. You can't deny this risk anymore. It's real, it's very clear. And finally, the Federal Reserve should catch up with what the Bank of England has done, the Bank of France, in calling climate risk a systemic risk and regulating banks and overall economic actors as it relates to climate. And my final thought is, we've talked a lot about risk, and climate risk is extraordinary, but the opportunity for investing in clean technology, clean transportation is equally as extraordinary. There's lots of upsides in this.
Sagar, I'm going to just give you a chance also to offer some closing thoughts. How would you characterize the level of ambition among investors right now? Do you sense that they are looking for ways to become more aggressive on this, or are they trying to just play sort of a more defensive game where they do enough to avoid attracting the ire of activists and to stay on the right side of regulators, and that's all they want to do.
I'm more optimistic than that. So I'm seeing really huge levels of collaboration now happening. I mentioned Climate Action 100 Plus, where you're getting some of these big, very competitive investment managers coming together with asset owners to think about how they change. But I think what unlocks this conversation from confrontation to change and solutions is really innovation. And that's what we know the finance sector can do. Where do we need to see the innovation? We need to see it in the financed emissions. So how can financial institutions, banks support their customers in transitioning all of the key sectors? So if you get rid of oil and gas, if you get rid of coal, you're still left with a bunch of other sectors that you need to transition, and bearing in mind different geographic diversity that there is as well in those portfolios. And the second is, where can we innovate in transition finance solutions? And then what are the next generation of climate solutions? And also policy advocacy. So how can we innovate there in terms of not only our asks domestically in the US, but how will we help get together EU, China, US cooperation on climate change for a sustainable recovery from COVID as we start emerging from this in 2021?
Eli, you get the last word, then we're going to bring Nigel back in. Your closing thoughts. What level of optimism or pessimism should our viewers walk away from this with? Oh, you're muted.
I'm so sorry about that. There's a lot that gives me a lot of optimism, and a lot of my optimism is driven by, frankly, the level of activism that we've now started to see around this sector. Finance's role in either fueling or at least being a bystander with respect to climate destruction was something that had gone unnoticed for a very long time, and is now something that is really on the minds of people taking action all around the world. There's a reason why grandmothers are gluing themselves to the walls of BlackRock offices in London. And it's because people really finally understand the fundamental role that finance has to play in transforming to the net zero economy that we desperately need to achieve. And so I'm feeling optimistic because we are finally starting to see the finance sector start to respond and start to engage in the level of conversation that we need to see here. At the same time, I really think that it is of fundamental importance to viewers here, to the audience, to be very critical consumers of the kinds of information that are coming out from financial institutions about their climate commitments, because it is really up to all of us and up to the media to make sure that that kind of talk is actually commensurate with the role that a financial institution has played in driving the climate crisis, and on scale with the actual level of power they hold, not waiting for someone else to take action, but the actual level of power they hold to take us to the future that we need to be. So
right.
That kind of critical engagement, absolutely fundamental.
Great. Let's bring Nigel back in. Nigel, do you want to join us for some concluding thoughts here?
Yes, thanks, Chris. And really, really fascinating listening to the conversation. And thanks for assembling so many different points of view. It also makes it a more interesting conversation, right? When we don't have to agree on everything. I mean, it seems to me that there's real agreement about the scale and the urgency of the systemic risk. I just want to re-emphasize again that these kind of transitions never happen in a linear way. So anyone thinking they can just softly, a little bit by bit manage their way through the transition, or play a defensive game, as you suggested, Chris, there's no winning defensive games in an abrupt transition. It seems to me we have all the pieces of the puzzle, right? They just all need to get to critical mass, whether it's the kind of net zero clubs like the Asset Owners Alliance. We need the equivalent for asset managers and banks and insurers, right? Whether it's the voting, the CA 100 plus, and I think the points made about making sure that members of that coalition actually vote in line is crucial. I think we've seen some work from Chris Hone recently and really looking to go from voting for directors to voting for transition plans, really concrete plans. No one's mentioned legal action. I think that we're seeing more and more legal action. I'm sort of waiting for the first legal action against an auditor for signing off the accounts of an oil and gas major who've fraudulently overvalued their accounts in light of what we all know about climate change and the points we made about the bubble of stocks. I think people hide behind the IEA central scenarios, which is not adequate, and behind the rules around directors making decisions about valuation. I really do expect to see something happen in the next 12 months. I think we've had a really interesting conversation about the fact that in transitions, which are disruptive, there are always risks and opportunities. And maybe, I think it was Jennifer saying we need to look in new places for the opportunities sometimes. So need to look under some unfamiliar stones. I think that the thing that we haven't talked much about, but the really, Greece talks about the inevitable policy response work, which the PRI have done, which I think is great work, looking at the shape of a non-linear transition. Man, we just been through a non-linear event which hasn't made it through to markets yet. China, net zero in the 50s, a Biden victory. If that doesn't lead to a net zero 2050 or 2045 policy from the USA, the UK is just about to firm up on its very ambitious plans for the next 10 years. The EU as well, Japan, South Korea, every major economy suddenly got a very big policy signal. That's going to come through into phase out dates for combustion engines. UK's just gone 2030. Everyone's going to go 2030 or 2035. These transitions are always exponential. And I think that 2021 is going to be the year when everybody gets that we're now looking at an exponentially accelerating transition in every sector of the economy that's got climate exposure. And that's nearly every sector. Yeah. And these kind of transitions are a very good way of sorting out winners from losers. The winners win big and the losers lose big. And I'm really looking forward to seeing the winners emerge and to the winners coming to Glasgow to celebrate driving this transition. Finance sector driving it, the real economy driving it, policymakers at local government and at national government level driving it, citizens driving it. It's one of those races we've all got to win together, but it doesn't mean that some people won't be lost along the way. Thank you.
That's great. Thank you, Nigel. Thank you to all of our speakers for spending the time. And to those watching, I'm glad we had this conversation. Hopefully we'll have many more. Whitney, let me kick it back to you.
Thank you, Chris, for that skillful moderation and summary. And thank you also to all of our speakers and to our audience for your participation and your questions. We look forward to welcoming each of you to our next digital event in the Netting Zero series, focused on fossil fuels. And that takes us into January 19th, 2021. You can find more information and register for that event and other events in the series on nytclimatehub.com, where a recording of today's event will also be viewable in the coming days. You can also find more digital events from the New York Times on timesevents.nytimes.com. Thank you everyone again, and we'll see you next year.